Well, kia ora, and welcome to Mark Wilkshire, who's the CEO of the Co-operative Bank, joining us here on the Kaka from Wellington. Lovely to see you again, Mark.
Hi, Bernard. Great to be here. Thank you.
Yeah, for those people who aren't perhaps familiar with the Co-operative Bank in its current form, could you give us a sort of a potted, history and sketch of who it is and what it does and who
Yeah,
for?
sure. So we're a customer-owned bank, which is a cooperative, and Kiwis are pretty familiar with cooperatives. The biggest one's Fonterra out there. We have some others in financial services like FMG in the agri sector, but we're a retail bank, and we're owned by our members. We've got about 180,000 of those, and so we're a customer-owned bank, a registered bank. Competing with the big majors and other New Zealand banks. And we've been a registered bank since 2011. Some people might remember us, and I get this a bit, as the PSAS, which goes back to our heritage, which we were founded from. So sometimes people say to me, "Oh, my dad was a teacher, or my mum was a nurse, or something on those lines," and they remember us from those days.
And is there any particular part of the country and the type of thing that people do with you?
We're a national organisation, so we're not tied to any particular region, and we target just our middle New Zealand really, where everyday Kiwis is who we look to support, and we're open to all these days and welcome, but we really focus on the personal customers.
So
The retail.
what are you seeing out there at the moment in terms of how your customers feel, what the market's doing, what's the flavor on the
Mm.
ground?
Yeah, it's an interesting period because we have been in recession previously, and it's a kind of stage now. It's what I call a slow workout. So it's still not easy for people. Inflation's starting to bubble up a little bit, just very early signs. And you can see things like rates, insurance costs have risen. So that hits people. So we haven't yet really seen us come out of that recession. So it's still, there's a bit of confidence emerging, but it's not strong yet. And it does vary a bit depending on where you are in the country. So I call it in this gradual recovery phase, but not easy recovery. It's not like a bounce back where we saw, for example, after the global financial crisis, it was a sharp dip, then a sharp bounce up. It's not like that this time. So we're seeing recovery, and we're seeing a bit of recovery and seeing a bit more confidence come back in the economy, but it's not a sudden bounce. It's a gradual work up.
Why do you think it has been stuttering? Because we've had, 225 basis points of rate
Easing.
cuts, and there's no what I'd call shocking disasters out there in terms of in 2008-9 there were a bunch of finance companies that collapsed. We had a
Yeah,
global financial crisis, and the
totally.
markets and housing and the economy seemed to bounce back within a couple of years. But we're now 3-4 years on from COVID, and it still
Mm.
feels a bit tough. What's going
It
on?
does. Look, I think one, it was a hefty bill to swallow post COVID. So I think there is a bit of digestion of those things that have come through the economy. And there's what I call probably a lot of soft, things like the casual second income, and as the casual labour market's got a lot tighter, people are far more cost conscious. And then as we try and get a bit of momentum, there's been a lot of uncertainty internationally, geopolitically. There's been some events. So I think it's been quite hard to get the constant momentum, just as we seem to be getting some good positive go forward. There seems to be another little event happen globally or somewhere that's kind of interferes a little bit with our growth expectations here in New Zealand. So we've seen that this year. So I think there's a number of reasons which have stopped a kind of a. But overall, I think it was quite a hefty bill we had during COVID, and it does take a bit to come out of that. It's not like some other forms of recession and recovery cycles that we've seen before.
So the last time we, had a big drop and a bounce back, 2008, 9, 10, there was a certain level of capital that the big four were required to have. And and other banks. And since then, there's been capital requirement reforms, and we've
Yeah,
seen some non-banks that have become banks. The big banks have basically seen their capital requirements doubled. The loan-to-value ratio restrictions have come in since 2008-9, and just in the last year, we've had the debt-to-income multiple
correct.
controls. Firstly, on those capital requirements, because they were controversial with
Mm,
the banks when the Reserve Bank put them in place, and there's been some pushback and some commentary politically that maybe that was a bit too tough. 1 in 200 years
mm.
was too tough a requirement. What's your view on those capital requirements?
Yes, it is a interesting move. New Zealand has had reasonably tough capital requirements put in place, and certainly for us, we've been at the conservative end, so we've held higher capital than other banks as well. So we have one of the highest capital ratios of all of the banks in New Zealand. So in some respects, some of the other competitors are being required to come up to that same level. Um, it is a higher level, and I think some of the settings do need a good look at, and there is a capital review underway. One of the things the smaller banks, from a small bank perspective, has been the unequal playing field, and particularly when it comes to holding capital for lending. So this is areas that all of the smaller banks made submissions in the inquiry and the select committee inquiry to say, look, actually, we think there should be for the same asset class, for the same type of lending. If you're lending in housing in the same street for the same family, it should be the same no matter which bank you are. So we've all made that point that we think that needs a good look at to iron out those inconsistencies between banks that are able to use advanced methods and those that have to hold more capital in standardized settings. And we think there should be some equalization of that. Whether that
Could you
happens on that will remain to be seen under this capital review. We remain hopeful, but we haven't seen any moves yet to make those changes.
Could you perhaps explain to people, you might have your bank and one of the other big four banks lending into the neighbours of your customers. And in the past, those big banks might have to put aside, $8 of their own money for
Yeah,
every $100 they lend to those
yeah,
neighbours. That was maybe doubled to around $16 or so, because
yeah.
they were able to use what they call internal models, where they
That's right.
could say to the Reserve Bank, trust us, we've got some good
Yeah,
data on how often our loans go bad, and we think this is about the right amount. And the
yeah,
Reserve Bank goes, oh, yeah, fair enough. But for the smaller banks, they weren't allowed to use those
yeah,
so-called internal models-based approach. The Reserve Bank said, hey, you're quite small. We want to be quite conservative. Your rule is for every loan, doesn't matter where it is, within reason, if it's a mortgage, you have to put aside a certain amount of capital. And obviously, and usually it was quite a bit higher than that. So let's say $8. It might have been $12 or $13 or
mm,
$15. So that doubling of capital requirements for the big four under the internal models approach has sort of evened up the playing field a bit on capital. Is that right?
a bit, but not. They're still different, and still. So capital is a cost for a bank. So for a smaller bank, they have to hold more capital and therefore have more cost for the same amount of lending for a mortgage. And a mortgage is a mortgage, pretty much irrespective. In fact, you can switch from one bank to another, and why should that therefore attract more capital that you have to hold, which is a cost and therefore a higher cost for you to hold? So that's been our argument that should be equalised, and there should be one methodology. And if they want to keep it conservative, then make it all standardised, but adjust those granular settings so that it's a level playing field. If we want more competition for banking in New Zealand, then why not make it the same settings for capital? That seems like a common sense thing to do in our view.
How much of an evening up actually happened there? Because the capital requirements for the big banks were about double, is how I describe it. Were the small banks also forced to put aside even more capital?
Yes, well, and so as I mentioned, we're sort of at the level that is required already, but yes, there's been a rising requirement to hold more capital. So for us that gets to we're already at 18%, but that's kind of the level we'd need, a little bit of a buffer above the Reserve Bank levels. And you've got others sort of between 15-17% today. So there's been this rising requirement over 3 years that you need to be at by 2028. It's interesting that there's now a capital review, so whether they remain, whether those same thresholds remain, but is probably still a question. And we'll see this year whether there's any changes to those requirements. The interesting thing for us is because we rely on our retained earnings as a source of capital, basically the profits we make, which are reasonably modest profits, then it takes us a while to build up capital. So we've already had to run ahead of that. So there's been a benefit for the larger banks of having had more beneficial capital requirements for a long history that's enabled you to build up those earnings profiles over time. So there's already been quite an advantage from those historical levels. So if they're changed or if they're lowered now, we already kind of had to put in the measures to actually get there already for that. So for us, that's what we've been focused on, is making sure we hit the right targets for the future. And I'm interested to see where the others land from a competitive point of view. But the big thing for us would be to have a fair playing field.
Because there's a couple of ways to get that fair playing field. Either the big banks' capital requirements could be lifted to match yours, and maybe they would go from 12 or 13 or 14 to 16 or 17 or 18, which I'm guessing that was not the capital reforms they were looking for. Or their capital requirements could be lowered, and the smaller banks, theirs could be lowered as well. In fact, lowered even more in terms of the gap, and you'd come back to some sort of even playing field. Is that the sort of way you think you'd get to that even playing field?
Yeah, I think there are a number of things that to be looked at, and there is like buffers in place, additional buffers in place for what they call systemically important banks. So there's an additional 2% requirement at the moment for the big banks, but that's kind of that's for a different reason. So we think that for the lending, they should be the same in those granular settings. I think they'll be very careful about lowering too much, and we certainly think we should have a well-run balance sheet and plenty of capital. So we sort of maintain our own rules around that as well, around where we want to be, as long as we meet the regulatory minima, but also look at what we think is appropriate for a business of our size. So we wouldn't probably lower too much, even if the regulatory minimum, we would just have a look at that. But I think more likely they might consider different sectors. I know there's been a lot of interest in the agri sector or business sector. Are they relative to the risks in those sectors? I think that's part of probably the brief to have a look at. Not affecting us. We focus purely on the retail market and retail customers, so housing and personal lending for us. So for us, the risk weightings there are quite important. At the moment, a large bank, for example, could get their risk weightings down to 21%, whereas the sort of standard for a small bank might be 35% risk weighting. So that's the level of difference. It's quite a reasonable difference. And there are flaws and other things that they have. It gets a bit technical, but we think that's probably an area that needs a good look at in the review. And we've certainly advocated that, as you say, having two sets of rules for the same asset class, for the same mortgage lending, that's the area we think is most concerning for us. And we can meet whatever levels, overall levels in the system. New Zealand's a pretty stable financial market. Good levels of capital overall. So we all want a healthy, stable system as well as a bank.
Yeah, because if you were quite keen to get some energy into the economy, one way to do it, not that I'm suggesting the Reserve Bank would do this, but if you were really keen to get the economy cooking, and maybe before the end of next year for some strange reason, it would be quite, you could do it by reducing those capital requirements for the big four banks, 2, 3, 4 percentage points, and maybe throw in 2 or 3 or 4 percentage points for the smaller banks as well, and say, hey, that's a level playing field, go for it, which would potentially, give us a bit of a lending boom. Do you think that's a risk or something that we should worry about or think about?
Yeah, I think my prediction of what will happen, I don't think they'll get to. I think they'll be very careful about too much lowering, but they might limit the level of increases that were planned. So I can't see a lot of lowering, but people might review the level of extra that has been forecast and laid out to be required between now and 2028. That could happen, and that there's international benchmarks to look at. There's other ways of looking at that. So, do we need the same levels of capital we've got? That's for the experts at the Reserve Bank and others to have a good look at, I think, and determine a view. We'd certainly be very interested in.
Yeah. So the other way, the other way that banks are restricted, if you like, in a new way from, let's say, 2008-9, is the loan-to-value ratio controls, which were brought in 2013.
Correct.
They were progressively tightened, then they were loosened. I think then they were tightened again, and then they were removed in a very exciting period immediately after
During
COVID.
the pandemic.
Yeah, and then there was a lot of excitement, and then perhaps a little bit of concern, and they were put back in a hurry. And then we've had the debt-to-income multiple controls put in. Now, the LVRs tended to restrict low deposit lending, particularly to first home buyers. But the debt-to-income multiples are essentially there as guardrails to limit the sort of strong lending growth to those people who have plenty of equity already, particularly if they already own a home or several homes. They might be a rental property investor. And as interest rates fall, you're less likely to see explosive lending growth to those owner-occupiers because the debt-to-income limits start to kick in. What's your view about those two lending controls, whether they should have been gone in to start with? Are they too tight? Could they be loosened? What do you think?
Yeah, and I think they came in at times. I think your history is really important here, that they when you've got housing booms, those loan-to-value ratios play more of a role. And we saw that period, you had that around that GFC, and then after that, when you saw periods of house price growth and the recovery phase of that, that's when there are concerns about those values getting too high, and are they too high? Is the market going to correct? So in those periods, and they were described as transitory constraints at the time when they were introduced. So, but now with the level of house price growth being quite subdued, they're not really, the loan to value ratios aren't really coming into play. So they're basically, the deposits people have against the prices that they're paying for mortgages, those are now more realistic than they have been in those boom periods. So right now, LVRs or loan to value ratios aren't really a major constraint, but they could be again in periods of high growth. I think the debt to income ratio is the one which is, bankers always look at servicing very closely, and can people afford to repay their debt? I think that is probably a more relevant and is a little bit more subtle depending on regions, where you saw particularly high debt to income ratios in Auckland during periods, is probably the one which does start to have more of an impact. So that's an interesting one. It'll be interesting to see how this plays out. I think you do have to be a little bit careful that we don't over constrain with too many rules, and so they do need monitoring to make sure that they are not overly constraining the market. At the moment, I don't think they are, because of the circumstances the markets we're in right now, but that may well change. So it's the watch out there is to make sure that they are regularly reviewed and are overly constraining. One of the concerns with those loan to value ratios when they're introduced back in 2013 was they did act as a bit of a barrier for first home buyers. So that, I think, you need to be very careful about that. And for us as a retail bank that supports first home buyers, they're a key market for us, getting people on the right path to property ownership if they want to. If that's a choice they want to make, that's really important to a lot of Kiwis out there that dream of buying a home. So that's one that can inadvertently constrain first home buyers more than investors.
Now, the other thing that's happened in the world of bank regulation, and it's happened quite quietly, if you like, given the importance of it, is the introduction of the deposit guarantee scheme. It seems to have slipped through Parliament and into the world without too much controversy or
fanfare.
drama. Maybe there's too much drama and controversy elsewhere these days. We just don't have the bandwidth for it. But, it's quite a big deal. New Zealand didn't used to have a deposit guarantee scheme apart from a period around the global financial crisis. And it effectively meant that it was buyer beware. If you put your money into a bank, the theory was, according to Don Brash back in the day, you were supposed to do the research on the safety of that bank. Have a look at the declared statements about capital put aside, what's happening with profitability, credit ratings, all of that stuff. Now, for mum and dad who's putting their money into term deposit, I think that was slightly unrealistic. And what we found out during the global financial crisis, luckily overseas, not so much here, but overseas, unless, of course, you had money in a finance company, but for the banks, what we found here was we didn't have that sort of traditional, and keep forgetting about it, but this is for a couple of hundred years, bank runs were a thing. They used to happen. And we didn't really have it here. But we also didn't have any protection. So the theory was, let's say one of the big banks, there was a run, everyone tried to pull their money out. And, sometimes for no, obvious or real reason, a bank there can be a run, and particularly in this day and age of social media, that can be a problem. So the Reserve Bank and the government decided, right, we'll move to a more traditional or conventional approach, which they have overseas, which is where there is a government guaranteed amount. When we say government, some sort of fund with the quality of a government that people can trust, that guarantees, let's say, the first 100,000 of the amount you have in a deposit. And that fund, which is there just in case, is built up over time with fees collected by the banks from their deposits and savings accounts, and that gets built up over time. That's in place. It's there. What do you think of that from your point of view as a smaller bank? Because one of the complaints a lot of the smaller banks had in the past was that they had to put aside a lot more capital. The big banks, in effect, benefited from a too big to fail type of guarantee, like the one that effectively was put in place during the global financial crisis. They got it for free, sort of, although they would argue they had to pay later on. But anyway, that's there now. What about from your point of view?
Yeah, well summed up. That's a great summary of Bernard of the deposit compensation scheme, and I think it's a good thing. The protection, the extra protection and peace of mind for people, having that reassurance and the stability of the banking system in New Zealand, that's good. And as you say, it's happened overseas before. If you look at Australia, US, UK, European Union, they've had similar types of schemes with the first 100 or other amounts. So here it's the first 100,000. And that's a good thing. I think it's helpful to people to have that confidence in the banking system, and it's like an insurance policy. And so it's not because there's any particular issue right now, but it's a nice way to put it in place as that insurance scheme, essentially, should there be an event or a crisis like we saw in the global financial crisis. So if you remember back to the global financial crisis, that was introduced at haste very quickly, within days, when there were US events, then Australian guarantees. And so we had to put one in New Zealand very, very quickly. It was Crown guaranteed. There was no levy or structure to it. It was just put in overnight. So to put in place a planned scheme that builds a fund up that's essentially levied against the banks, then that builds up that pot over time. That's a good thing for New Zealand, I think, and a healthy thing to have that protection in place for customers. And it basically reaches about 90%, a bit more than 90% of customers have that cover.
Has it changed the flavour in the market at all? Because in theory, there'd be a bunch of people who have more than $100,000 in an account. It's always surprising when you tell people, when they say, "Oh, there's not much money around. Money's pretty tight at the moment. Everyone must be really struggling." And then you go to them, "Well, actually, no. There's $250 billion in term deposit accounts just sitting there." Doing nothing. Well, it's earning a bit more than it used to, but it's just sitting there. $250 billion, it's highly unlikely that's in $100,000 lots in various bank accounts. So has there been any change in the market there?
yeah, then this is what we've seen internationally, not a lot. And as you say, in theory, a whole bunch of people could sort of spread that around different banks and use those thresholds, but no, we don't. People generally, I think, look at the system in New Zealand and say it's pretty secure, so they're not that engaged to make a whole lot of changes. But there are some, and we have seen some interest. And so at the margin, there are a few customers who do that and who exercise their choice. So the good thing for a challenger bank like the Co-operative Bank is we go, oh, okay, we are quite high in customer preference ratings and customer satisfaction. So we do see that as a bit of an opportunity. And our deposits are off to a really good start this year. So it might be coincidence, or this could be a factor. And I think it's probably is a bit of a factor with some other things as well. But yeah, we've seen our deposits for the first quarter of this year grow more. And so there's a bit of opportunity perhaps there to be a bit of a prompt for people to think about where they're putting their money and which bank do they want to be in. And there's always been a bit of inertia. A lot of people are with the big four banks. So that's just another reason for people to have a think about, oh, what are my choices now? I've got this deposit compensation scheme in place. I can look around and I can choose a bank. So it's empowering for people to have a bit of choice and to have a bit of a think about where they want their deposits. And we certainly see some opportunity to make sure we get our name out there and make sure people consider us, given we've got high net promoter scores and customer consideration scores.
Now, the other big issue at the moment for New Zealanders is extreme weather events. We seem to be having more and more of these extreme, and they seem to be getting more and more extreme. And that's because climate scientists tell us the warming climate makes these events more frequent and more extreme. And this is something that the banking and insurance sector and government and councils are all thinking about at the moment. You know, how do we adapt? How do we insure? How do we relocate? And so it's very interesting and topical for banks and insurers, and the Reserve Bank is working on this, thinking about this a lot. And I'm sure a lot of the banks are, you know, having a good look at their books and trying to work out what their risks are and all of that. What's your take on extreme weather and the risks to particularly houses, but you know, there's a lot of other things as well that get affected. You know, cars, land, all that sort of thing.
Absolutely, and very timely and very topical at the moment with what the poor people in Nelson, Tasman are dealing with right at the moment, and having multiple events hitting them in a short space of time. And you know, it wasn't that long ago that we saw Cyclone Gabrielle in 2023 in Hawke's Bay, an area I grew up in, and we used to see floods quite regularly and through there. But that was a whole next level with Cyclone Gabrielle. The extent of that was quite devastating. And so you're seeing some of these more severe and more frequent events, and generally accepted people are saying there does seem to be a likelihood of linkage to this climate change, that these frequency of these events and the severity of them does seem to be related to a wider pattern we're seeing globally. Therefore, it's quite a big concern and risk, as you say, for people lending, for credit risks, but also for people to adapt and say, well, what do we do and who wears the cost of this, which is the big question facing people right now. So I think some of this debate and discussion about those big questions long term, what is the adaptation plan? As you say, it's really important to have a good look at what we can see. And I think our role for customers and for people out there is to play a bit of a role in making sure they ask the right questions, particularly when it comes to a credit event like buying a property or getting additional lending or changing the situation. Is, do you understand those risks? Are they available? What can you see that's available? This is an emerging area of data, I think, particularly for councils with the LIM reports, is what can people see? What information is available? So we might be able to prompt customers at the right time to say, what, have you asked the right questions? What's the due diligence you're undertaking in some of these areas that are more flood prone? And as we start to work with insurers and find out more about what are those areas, we can help prompt customers to make sure that they do the right due diligence. And you know, we have both buyers and sellers, so we've got to make sure that that's done really fairly for people, and so that they have access to that information. And that's our role, I think, to play, and with other banks and insurers, is to play that role. And whether we can give them guidelines and checklists to follow and prompts and ask the right questions at the right time, that's the role, I think, for a bank to take really seriously as we look at those trends and say, you know, actually inundation risks particularly from rivers in New Zealand, was we have a lot of areas. I mean, the coastal one's quite clear, but also the inundation risks you get in those flood-prone areas, low-lying areas with rivers running through them. That's also a big risk for New Zealand. It's part of our natural beauty, but it's an area that we are now starting to get data on that we have to adapt to with climate change that's related to these events.
An independent experts report came back to the government a couple of weeks ago and said, government can't afford this in the long run. We're going to have to phase out bailouts. And the insurance sector is saying that the risk here is that there'll be some parts of the country that are uninsurable. And from a bank's point of view, it's pretty difficult to give a mortgage on a property that's uninsurable. And the risk here is that the government pulls back its involvement and responsibility. The insurers pull back their responsibility. And, we have a bunch of people who are sort of hung out to dry, for the want of a much better phrase. What's your view on how this should go? Should we have a climate adaptation act? Should there be clear rules about, who gets bailed out when and for how long? Should there be some sort of government subsidy for insuring some of these areas? These sorts of things. Do you have views on them?
Yeah, these are big questions affecting us nationally. I do think there is going to be need for a role of multiple players throughout the whole system in New Zealand. And some of those questions I think you're raising around what kind of regulatory framework and what those, I think there is a role for central government in starting to consider those issues. And then there's a role of local government around particularly the consenting process for what they do going forward with consenting and how they manage that for customers. And then there's a role for people like insurance when they have those incidents. So there's a whole layering of roles of different parties involved, and I think there's a need to work quite collectively across that whole sector. And some of those big regulatory questions I think you're asking are a role of central government to get their head around. And there's, I think, going to be a need there to help provide some clarity, because the ad hoc nature of coming up with a response, whether it's north of Auckland or Hawke's Bay or Nelson, we can't, I think, have a system where you have to make that up each time. There's going to need some kind of framework for that. So I thought the report that was just tabled around introducing the debate around what is the adaptation framework, it's the right questions to start to address, and who is liable in those situations, who does bear the cost. And as you say, there are people out there who have properties, and they may have situations where they're now starting to understand risks that they weren't aware of before. I think that's the big problem, where you start to become now more alert to the fact that actually this could be more a risk than we realised before. It's a little bit like, in some ways, to the emergence of the leaky homes scenario, where suddenly people were, the building area in the 90s, a certain type of cladding, a certain type of building type, through a particular period. And you said, actually, there are now some factors that you're aware of now that when you're buying a house, you need to be alert to. But there was a number of people that already had those properties that suddenly go, okay, well, how do I deal with that? And maybe my value is affected 20, 30% as a result of being one of those types of builds. And often they had to wear the cost of that. So I think addressing, how do people handle that? How do people wear the cost of that? And I think there will be an element of people who are homeowners having to adapt to that and get their head around some of those risk factors will be part of it, as will the responsibilities of insurers who are meeting costs today of incidents when they happen and affecting those into policy premiums. So yeah, there's a
range of
lot
issues.
of answers to come, I think, around how that's handled over the long term.
Because at the moment, it seems to be government quite reluctant, and councils reluctant to put their hand up and say, "Yeah, I'll pay," because then that might make it difficult to make a tax cut or repay some debt or whatever. So often it's a bit like in the outfield at cricket. Yours, mine, yours, mine. Oh, look, it just fell on the ground, and so
and how big is it? Like if we do that, then how many more? And some of those early estimations are in the billions in terms of the potential higher risk factors for the properties. It could be higher risk of inundation. So I think the concern is, well, where does that stop? And so what is the size of that issue? So I think starting to now quantify the size of that is the right place to start. What is the risk? And therefore, how many properties could be affected? How many of them are high risk? Now who pays? Start working through those questions systematically.
Yeah, because one of the issues here is that the insurance companies typically roll over their policies once a
Every
year.
year.
Yeah, they may change the premiums or the terms and conditions. And if you have a house that you own and you've got an insurance policy, you might have a mortgage. But the mortgage maybe doesn't roll over until 3 or 4 years, or maybe not for 20.
Yeah, like I say, it might be a 30-year mortgage. So yeah, we're in it for the long term. So working with customers and working with people in the community here is really important. And for us as a bank, with that long-term view, working with insurers and insurance partners is also really important to deal with that. So yeah, we may start to look at areas and say, well, you start being a bit more careful about a low-lying area next to a river. And so those are some of the things we might start to flag with our customers as well around are there risks there that you are thinking about over the long term?
Are you at that point yet? I mean, there's some parts of New Zealand, Westport, South Dunedin, a few other places where the insurers are just quietly, not renewing policies or saying no, or say go and talk to someone else. The risk here is that the banks are sort of behind the curve, and before you know it, their customers turn up and say, "Hey, put my house on the market, but I can't quite sell it." So, what are you as a bank doing to sort of, get ahead of the curve and not be the one holding the parcel at the end?
Yeah. Well, I think, and to give credit to the insurers, I think they aren't knee-jerking. They are being quite careful and responsible about more of a managed process here, and not suddenly excluding a whole lot of areas. So, there are some small pockets around New Zealand which are well known for, not being insurable anymore. Having grown up near Hamoana and seeing some of those properties get smashed there, you can understand that over time people start to pull out of there. But on the whole, those are small pockets, and people are very careful about pulling up the shutters. And so we're not at that point of saying we won't lend in a particular area. What we might do is we might ask some more questions, and we might say that actually that looks like a higher risk area, and maybe we need a higher deposit. Are you fully aware of those risks, and have that conversation with customers? So that's our response currently. Now that we'll have to keep looking at as we get access to more data over time. And I think what we do need to be doing, and there are some good third-party providers of data here as well, like the CoreLogic, now called Cotality, who look at this type of data, and there are also reinsurers out there as well who have got models that can help. So we're actually working with the insurers, and I think this is an area we will need to collaborate as a financial services sector as a whole to make sure we're doing the right thing and making sure the right term decisions are being made over the long term for people, so they don't get shocked. And we do have a transition period, and don't suddenly surprise people.
Thank you very much, Mark. Lovely to chat about these things that are of big interest, but appear quite nerdy. I think they're really important. Thank you very much to Mark Wilkshire, who is the CEO of the Co-operative Bank here on the Kaka. Thank you, Mark.
Thank you, Bernard.